Hi everyone, cheers. It's been a long day and I'm recording this at the end of the day. I finished my trading for the day and I'm having a bit of beer. I'm a big fan of Belgian beer. I don't want to be one of those guys that end up being drunk and doing this anyway, but I could see myself being the drunk trader. Okay, so today is part 3 of at least the most, I think, significant 5 trading myths that exist out there that I think get newer traders into trouble. And they're widely prolific and they are propagated, which really just means that nobody ever really says anything about them not really being as true as they are, and nobody really kind of researches it. And I think they just get spread out there and it just becomes normal. And an example of that would be that there's a correlation between gold and when the stock markets are strong or weak, or there's a correlation between the markets and the US dollar, so on and so forth. And we'll get to that. That's absolutely another myth to deal with another day. Okay, so I realize that I appreciate that the length of these videos can be quite long, and I want them to be long only when they add value and not to just ramble on and on. Okay. So this is there's meant to be 5 parts to this so far, and this is now part 3, but I want to reiterate, these are the things that I have to repeat to make sure they make sense, that a trading strategy is a written description of a visual pattern that we see in the market. Okay, it occurs on a frequent basis. Now I'm generalizing, this is the average strategy that most people will use to earn a primary or secondary source of income. Okay, trading and investing are not the same thing. We are talking purely about trading the financial markets here, and we need to have a system that we can use to regularly extract profits from the market. That's the goal. And again, anyone who contradicts that, I'd love to hear from them, but that's not what trading, or at least that's what trading is meant to be for the average person. And I think that this is a skill, it's a learnable skill, and I think that everybody should engage in, certainly, in investing, some of their affordable savings in the stock market, which sounds like investment advice. What I mean by that, to be clear, is that I think that most of the most wealthy people in the world have gained from either property or stocks, and therefore that would indicate that the average person should consider property or stocks as an option when trying to increase their personal wealth. There we go. So a strategy is a written description that describes a list of criteria that surrounds a pattern or that occur frequently or are correlated with a particular formation that occurs on the charts if you're a technical trader. And that if it is executed around faithfully, so we put our entry and our stop loss in the right place, it is just much more likely to unfold in our favor than against us. It's not a guarantee, but statistically wise, way more than 50% of the time it should unfold in our favor. 60%, maybe 65 or 70% of the time it should unfold in our favor, and the profits should be greater than the losses when it doesn't go our way. That's really what a strategy is. So on the agenda for this video is the point number 3, which is trading the news. Now this is one that I have to kind of make sure that I don't get too emotional about, because I have a bit of this one gets me a little bit passionate, because I think that it's one of those ones, again, that is touted out there as something that all traders are doing. Why aren't you doing this? This is what you should be doing. This is where you get in. And actually, this is absolutely the closest to gambling that I can think of. It's mixed in amongst everything else. So you won't determine that trading the news is necessarily a bad thing. Sorry, this slide, just to give you some background, if this is the first of the videos you're seeing, this is me speaking at certain events. These are some of the clients I have. I'm very proud to be part of the team at Trade with Precision, providing, in my opinion, the highest quality technical analysis that is out there. There are some superb technical traders out there. I think Trade with Precision also provides that highest standard. And also some of the clients, and this is by no means complete, but it's to give you a bit of kind of background behind me. So before we kind of kick off, one of the skills that we need to develop as a trader is the ability to trust ourselves, to have faith in our own critical thinking abilities. And that is connected to self-confidence. So the more we trust ourselves, believe it or not, as a byproduct, the better our self-confidence will be as a consequence of that. But in order to build up our critical thinking skills, we have to start by trying to make decisions for ourselves, regardless of what the outcome is. We've got to try to learn how to make good decisions. And good decisions come at a price, which means that we can make mistakes. We can maybe not have all the information we need. It's a learning process. But what I will say is this: the actual ability to determine and evaluate a situation and make a decision as a life skill gets better really quickly. The actual process will teach us how to make better decisions faster and even better decisions than we might have made before. But the only way we can get to that place is by starting by trying to learn how to make good, wise decisions. With regards to trading, it really means about focusing on the things that will progress our journey. And the problem is there's a lot of misinformation out there and a lot of disinformation out there. What is the difference between misinformation and disinformation? Misinformation is bad information that sends us in the wrong direction, but not intentionally so. It is just propagated because people who propagate it think that it's true. They have no ill intention when they do it. Disinformation is intentionally bad information. It's willfully sending someone the wrong way. Okay, so there's a difference between the two, and they both exist. So misinformation might be somebody saying trade the news. You know, as far as I know, I've heard historically that's a great thing to do. Disinformation could be the exact same thing. Someone saying, I know statistically, I know the numbers, you know, it generally doesn't really work out well, but do it anyway. And so there's kind of a difference anyway. So let's kind of roll forwards with this. So the myth number 3, and they aren't necessarily done in any order of importance, but they're all regularly, I encounter them. So how do I know this? I'll be speaking at an event. It'll be at and I'll be speaking to a room full of 200-300 people who are either new to trading or have even been dabbling with trading for 10 years, 20 years. Every morning they play a bit of the DAX, or they do a bit of this, or they do a bit of that. And I've noticed after doing this 50, 100 times that people come and chat to me afterwards, and they all start kind of talking to me. And I noticed there's a series of the same issues that tend to come up. And that's kind of what this is about. That's what the series of videos is about, is what if we could collect all the universal issues that traders encounter that don't really help them, but that nobody ever really says to them, this maybe isn't true. And so one of those is trading the news. And part of that is this belief that this is what the pros are doing. So when you have non-farm payroll, that all the pros are in there, and that's where they're looking to make kind of, the US are doing it, and that's where they're looking to trade their money. So let's talk about that a little bit here. Okay, so first of all, let me read the points on the slide, which is somehow it has become a mainstream idea or an accepted idea that trading news is a great idea. In the same way that it has become apparently an accepted idea to ask foreign governments to interfere in your election. My point is that just because something is allowed to pass without enough people objecting to it, doesn't mean that actually it's acceptable. Don't assume that all adults know what they're doing, and don't assume again that all the people who are in the trading industry are either actively trading or successfully trading, right? An industry like the property industry, as an example, has a range of different people in different roles in that, all right? Not all of them are doing the same thing. In trading, you have salespeople, you have marketing people, you have traders, you have investors, you have analysts, you have a range of different people. So it's a mistake to think that everybody in that industry is doing the same stuff and that everybody's actively trading. So somehow it has become a mainstream or acceptable idea that trading the news is a great idea. Not only that it's a great idea, but that actually everybody is kind of doing it. It's a relatively active, active activity. That's not what I mean to say, but it's everybody does it. The belief is also that this is what all the best traders are doing. So this is not something that is necessarily always said, but it's kind of implied for newer traders that this is something you should be participating in. It's going to be fun. We're going to watch the news spike. We're going to see all this stuff happen. It's going to be really thrilling. And then maybe we can benefit. We can piggyback on a trade there. And I've done this. I've done it, I've seen it, I've participated in it. And I have to say that the market today, first of all, is not necessarily the same as it used to be 10 years ago. 10 years ago, if you had a strong, if cable was strong, sterling against the US dollar, and a news announcement was coming up, and the market had kind of gone into a bit of a coma, and then the numbers came out, and the numbers were positive for sterling, the market, for the most part, would react positively to that. So there was a correlation between the market's behavior and the news. That isn't the case today, and it actually hasn't been the case, I would say, maybe even going back 10 years. I don't think it's been the case. I would say more often than not, the way that the market reacts to the news is very random. And okay, so the point number 3 here being combined with the possibility of quick gains. So in other words, the market's going to move, and the news, and this is another one, this is an absolute, this is both misinformation and disinformation, that it's the news that drives the market. And I think that's where I really start to get a bit passionate about stuff. This appears to be the idea that it's the news that really drives the market, and that all market moves come from the news. And that is, for want of a better expression, crap. Complete crap. And it's not at all the case. All right, the single biggest mover of currencies over every year, on a month by month, quarterly by quarterly, month by month basis, is generally the interest rate differentials between central banks. That's where the big money is kind of like, let's ride this out, let's benefit from the difference between this central bank's interest rate and this central bank's interest rate, which is effectively known as a carry trade. That's the single biggest mover of currencies, all right? The single biggest mover of stocks is either going to be stimulus, which is surplus cash. Where do I put this in terms of benefits of getting extreme amounts of growth? And prior to that, then it would be, well, where can I put it, where I can get some kind of active growth on it? So that would be supply and demand. And that supply and demand would actually be, this is how much free cash I have to invest. Where can I put it where it's going to give me a return? As opposed to, oh, I love that iPhone, I got to get me some of that Apple. There's a lot of layers of activity going on there. And so combined with the possibility of quick gains, large profits, this is attractive to newer traders and ideal for growing their accounts. Now, for the newer traders, you have to understand that there's a couple of things that happen during a news announcement. We have key support and resistance levels. Now, they are actually the single most important element on a chart. Let me present my case to you for why that is. Before we had computers on our phones, before our phones, we could trade from our phones, before we really even have desktop computers, if we go back 50 years ago, when most of the traders were in the pits at the exchanges, they were watching numbers, not charts per se, but numbers. And so those numbers became potentially significant price points where price couldn't get beyond that. There was no one willing to buy above a certain price level, or it broke below a certain price level. And so there was this observation that traders detected that certain prices had significance. And as soon as we started to draw them onto charts, we started to note those prices because we could see on the history of a chart, that's where those key levels matter. They matter because that's where the chart, where price action or the history of a specific instrument has changed direction in the past. So the most important elements on a chart that you need to map out are key levels. That's actually a separate discussion. But what's interesting about it is that we have different degrees of budgets in the market. We have small fish, and then we have big fish, and then you have whales, right? And the whales could be institutions, very wealthy individuals, and they will tend to want to do their transactions at key levels. There's a couple of reasons for this. First of all, they're not in a rush. They're not trying to do 50 trades a day. They're trying to do large amounts of transactions, which is a liquidity issue that big fish encounter that we don't really have to deal with. And so what they like to do is they will generally wait till the market gets to a key price, and that's where they will transact, and they will do their transactions with other fish, because if you've got to get into a trade, somebody has to get out. If you want to get out, somebody has to get in. And so larger transactions tend to take place at the really big key levels. So you will often see that the market will move to a key level, amazingly enough, when a major news announcement is coming out. And that's because there's a correlation, sure, between news announcements and hyperactivity in terms of trading and liquidity and volume, and everything tends to go up, but also that allows the big fish to exit or gain or add to their positions as they go. Otherwise, what they have to do is they have to just break down their orders into smaller chunks and just keep scaling in or scaling out as they go. And that's a major issue when you're dealing with 100 million or 300 million order, that, in terms of that. So these are things that the average minor retail trader wouldn't necessarily be aware of, but when you work in the city and you're trying to trade 10 million on a news announcement, why you have trouble getting orders filled, and liquidity and getting that connection to the bank is as important as possible. So just understand that often, so to recap on why I say this, is that the market arrives at these key levels where the big fish are transacting because they have to, because that's the only other place where the other big fish are transacting. And so there are large orders going there. So there's slippage, there's an increase of orders, there's volatility, algos now trading on top of the news as well. And so it's almost more like it's an opportunity just to do business, just to do sales and buys, just hand over, just people can kind of manage their positions. And in between, you've got the retail traders trying to kind of make sense of this. Now, it doesn't mean that you couldn't potentially go, okay, I think the number's going to be positive. If I see it's positive and I'm on the 1 minute time frame, or I'm looking at ticks, I'm going to buy, and then I'm going to have a trailing stop and I'm going to do it. I mean, that's great. Those are that's one way of approaching it. The problem with that is that actually what we really want as a trader, and this is the crux of where I'm coming from on this one, is as a trader, what we need is the ability to confidently extract profits from the market on a consistent, kind of repeatable basis every day. Okay. Some days we're not going to catch a fish, but the idea is that most days we'll catch a fish and take a fish home. Sometimes 2 fish, sometimes 3 small fish, sometimes 2 big fish. But the whole idea is it's consistent. We have to know with certainty when we wake up in the morning that there's actually a greater probability we're going to take home money than not. And if you're not feeling that, that's because of all the kind of things I'm covering here. So even if we know, if we have a magic 8 ball or a crystal ball, and I'll say to you, you know what, NFP is going to add, the US is going to add 200,000 jobs, this week. We still cannot predict how the market is going to react to that. Certainly not today. That market could swing 150 pips in each way. It could swing one way, start falling, and then an hour or two later it turns around and skyrockets or goes the other way. So the way you have to see this is it is introducing chaos into an otherwise calm market. So the truth, professional seasoned traders, especially those who have been managing funds since the 70s and 80s, when trading was kind of really kicking off, these guys would have been in, and they would have been mostly men. There obviously were a few like Linda Rashko, who would have been a couple of amazing women who were kind of getting in at the same time. But they would have been pit traders, and so potentially, or they would have been traders working from these clunky machines at home, or they would have been working at would have had a seat at the exchange. So they would have been doing all these various things. They would have been young, most likely under 30 for most of them, possibly even in under 25 for most of them. Okay, which means that today they have paid their dues. They have done this. They are not looking for stress, as with any other pro. You know how to put the least amount of effort in to get exactly the same kind of returns that you were getting, or at least you know exactly the right amount of effort you have to do and to get pretty much the best returns you're going to get. And so they would have optimized it to that point, and they would by now be managing, they'd be at the top of the chain. So these are senior traders and they're whales. They handle the big money. They're simply just not interested in noise and stress and situations. What they want will be to cherry pick the easy stuff. The stuff that's easy for them might not be easy for the newer traders, but for them, they know where it's pretty much assured wins because they're doing it. And trading the news is not assured wins. There's no way that trading the news every day is an assured win. It is a lot like playing the slot machines at a casino. It is just like, let's see what happens. And so humans are incredibly bad at trading noise. This is also something you have to know. We are terrible at trading sideways markets because we just are. And computers could trade noise very well because they're just trading probabilities, and they can calculations per millisecond. It's insane. They can do that. However, humans are much better at trading trends. We can spot a trend and read price action with our eyes way better than computers can at this point in time. Certainly with AI, I was going to say with the advent of AI, that could change. But for now, humans are much better at reading trends than that. So, news events are also highly unpredictable. So even if we did have a magic crystal ball that could show those numbers for us, reveal them to us for the economic news, we could never anticipate or trade the market's reaction to those numbers on a consistent enough basis to make a living doing this. And so newer traders are under the impression that somehow all the pros have already calculated how the market is going to react to Joe Biden winning the presidency or Donald Trump losing it or to NFP or to any kind of thing, and are sitting there and just ready to kind of do it. And so you see these market moves and then you just presume that of course people made money. But you can have situations like that where everyone loses money. It is actually possible for everybody in that situation to lose money because they all got in at the wrong time and got out at the wrong time and they all lost money. Just because you see a lot of activity does not mean that all the wisest people made money and, you know, and other people lost money. It doesn't work that way. And I'm always with Warren Buffett on this one. He's kind of the opinion that if you just stuck your money in the S&P, you'd outperform the average hedge fund, if not all hedge funds, year on year, especially the NASDAQ, and just put your money there. And he's always taken a bet that hedge funds just ultimately will never deliver a return. Now, I know one or two that do very, very well, but as a generalization, they're not as excuse my language, they're not as shit hot as everybody makes them out to be. The individual retail trader applying an well understood strategy can outperform them, but that's because they're not managing other people's money. It's because they don't have to apply to the same rules of risk. A hedge fund cannot afford to put 1% of their budget on a single trade. That's insane. They can't do that. So of course their returns relative to their risk are going to be a lot higher. So that's a separate discussion again for another video. But news events can create choppy, wild swinging conditions that tend to tumble traders around more than reward them with daily profit. So what I want you to take away from this is, if our goal is to enjoy trading and to grow our accounts and earn a secondary or primary source of income, and do it on a relatively steady basis, that just doesn't seem to point to the fact that trading the news is definitely the way to do that. And so I found that as soon as I kind of walked away from doing that and I focused on what actually happens in between the news events, that's really where you can get a strong move. Right now you can get sterling was flying today, and then of course earlier in the week it was kind of dropping heavily, and a lot of that is also driven by the US dollar. So this is, again, it's a separate discussion. There's a lot of different topics that I could talk about for 20 minutes, and so I might as well put it in a separate video. My point being is that also we get this belief that somebody's Twitter post is what then triggers a euro dollar move. And although on a smaller macro basis, it's possible that something coming out, such as there's a treatment for coronavirus, could create a boost. Yes, logically, rationally, something like that could buoy the market, make it feel better. Or as the Americans say, buoy the market, which is obviously not what we're going to say here, but it could make the market kind of optimistic and there could be a positive response to that. Absolutely, that is a possibility. But at the same time, what absolutely happens is we get spikes in the market, and then everybody looks around going, well, what caused that? You know, and then they go, oh, well, some guy said something about this, it must be that. And then everybody just links the same article, and then everybody looks back and goes, well, that was what caused the move. So there's a famous Latin saying, and I am going to go find the saying now, because I think I've referred to it before, and then I'm going to come back and I'm going to tell you what it is. Okay. So I've updated the slide. So there we go. This is what it's called. It's a Latin saying. You need to know this one. It's called post hoc ergo propter hoc. After this, therefore because of this. It is a regular human mistake we make. Something happens, something else happens, and we go, well, that must have happened because of that. And all there were two events that happened sequentially close to each other. This happens on a regular basis in the markets. Something happens in the market, everyone looks around, something else happened, oh, it must be because of that. All right? It's not impossible that it is connected. I'm just telling you, 100% of the time, they are not always connected. Don't make the assumption that the news moves the markets. That's where we get our movement from. It can create spikes, but it is not the main driving factor behind the average daily move. And that a spike could be caused by something. It's possible, but maybe not. Okay, could just have been two separate events. Okay, and these are things, when I repeat it, it's so common out there, and it's just junk. Okay, it's just not always the case. So what am I supposed to do then, Adam? Hypothetically, Adam, if hypothetically you were telling the truth and this is kind of the approach I should take, what should I do then? Well, see trading the news as a culturally popular activity, kind of like playing the slots at the casinos. It's an easy sell for traders to the public. Now, I want to go back to that playing slots at the casinos. Why? Because, well, that's gambling. Trading is not gambling. People can gamble when they trade if they're not doing stuff the right way. Gamblers trading are often gambling. But trading, as it's intended as a financial activity in order to grow our wealth is not intended as gambling. It's called speculation, and speculation can have both meanings, but speculation is meant to be a calculated risk. Calculated risk. The reason risk exists in that sentence, calculated, or in that phrase, calculated risk, meaning is it's not everything. It's calculated, meaning we've said, okay, I can afford this much. I believe this risk is worth the potential win, and the probability is the win. So it's an easy sell for traders to the public to create volume and activity, all right? And even some middle of the road traders do it sometimes, especially NFP, non-farm payroll, because they can't let go of the idea that they could make money maybe. So that's what drives even mid-level traders in big institutions to dabble with non-farm payroll as an example, because they also can't quite say, they feel that that could be a money-making opportunity. And they might be reporting to someone senior who is appointed to the role who actually has never traded. And so you get a dynamic setup where they go, well, you're the trader, I'll let you decide how we make money. And the trader is going, well, I've got to make money, so I'm going to do this. But that particular activity has higher risk and lower probability, whichever way you want to put it. You know, and if I kind of stir up a few things, I accept that that's a possibility, and I'm data driven. So if you can show me definitively that trading the news is a positive activity that all traders should learn how to do, I'll do a video on it. I'm quite happy to retract what I say and present the case. Next one, accept that consistent results come from more predictable and higher probability market behaviors. See it instead as gambling, all right? As a chance or luck-based activity, and stop doing it. Stop doing it. Just stop doing it. Don't do it. Understand that it is random and it is like rolling the dice, and you don't know how you're going to do, and it can often involve revenge trading because you're on the wrong side of it, and then it turns out you were on the right side of it, and you just keep getting kicked in the nuts by losing money. So accept that that is not really what trading is supposed to be. Trading is supposed to be, I see this pattern, it's high probability. News is coming out here, so it's a bit too close. I want to get in this, but if I'm in profit and the news comes out, the news could go in my favor, but 50-50, it could go against me and hit my stop loss. So I'm going to pass on taking this here. Then maybe an hour or two later after the news, you see the setup, market still looks good, you place the order, it triggers, and then it unfolds statistically the way that it should. So see it instead as a gambling activity because it is higher risk, lower probability, because the market can swing wildly. Even if we could see the numbers, we cannot predict how the market will react to it. And I know this regularly. I hear all my fundamental friends going, but the numbers were great. Why is the market dropping? And that happens logically because they are not the first people to predict those numbers. Those numbers were likely calculated by very smart analysts. And so the market has already calculated it in. Just assume that the market has always priced everything in. People who are better educated, smarter, more experienced, do not read the newspaper articles. They have their own sources and their own methods of calculation. They've calculated it in, and they might go, we expect the number is going to be really positive. So what we're going to do is we're going to start buying into that position now. And when the news is released, we expect it to be at this point. That will then allow us to exit our positions at profit when the other big whales come in, and we'll take our profit. And when a lot of people end up taking profit, the market drops. So what I'm saying is when the market moves on good news, that could be because the market was positioned that if the news comes out and it's bad, they've already reduced their exposure. But if it does come out good, they can add exposure. And so suddenly the market moves on that. There could be various different transactions that are taking place. Just assume that the market has already priced almost everything. The market prices everything in that it knows is coming. What it doesn't price in is stuff it can't expect. So earlier this year, February and March, we had the massive wobble on the market because of coronavirus. Nobody saw that coming per se. Obviously, the Obama administration was talking about it, and even Bush was talking about, we're going to have these pandemics they're going to kick out. We need to make sure we're prepared for them. If you search the news, you'll find all the videos that talk about that. So they knew it was going to happen. But we also didn't know that it was going to quarantine people per se, and that we wouldn't, that suddenly we weren't driving anywhere, and global, kind of global climate change was going to benefit from it. We didn't know those kinds of things. We didn't know that ships, oil shipping ships, were going to just drop down to zero activity and oil would drop down to zero. You might have been able to guess that was going to happen. What I mean is I think the whole world was like, what happened? And there was a bit of panic and the market reacted to that. So that's really kind of where I'm going with this. Next up. Okay, so this is what I want you to do, please. Obviously, if you're watching this on my channel, please subscribe. I do need to up my numbers to make sure that I keep putting good content like this out there. I would like you to like 2 videos for me, please. Any of the 2, but ideally the 2 that you think every other trader who's like you should see would be the best ones. If you can get 10 people to do that, I will give you an hour of my time in terms of mentoring. I'm pretty good at it. And I can get people to consistency, and I'd like you to do that. So you can find me here. And I hope that you enjoyed this. Please feel free that if you want to contradict anything I've said, or you have a different opinion, or you kind of got value from this, put it in the comment section. I'm pretty responsive when it comes to that. And otherwise, yeah, I thank you very much for watching the video, and I look forward to delivering good quality content to you as well in the future. Thanks.